$60 billion. Not lost in a stock market crash, not wiped out by some Fed rate hike, just gone because someone called their coin stable. That's what happened in May 2022. And the people who lost everything, they thought stablecoins were the safe part of crypto, because that's literally what they're called, stable coins. So let's talk about why that word is one of the biggest lies in modern finance, and why the structure of most stablecoins makes failure not just possible, but almost mathematically inevitable. Quick setup first, because you need this before any of the rest makes sense. Bitcoin goes up 40% in a week, crashes 60% the next. Ethereum does the same thing. The whole crypto market moves like it's running on pure emotion. So developers looked at that chaos and said, what if we made a coin that just stays at $1, always, no matter what the market does? That's a stablecoin. It's supposed to be worth exactly $1 every single day, every single hour. You can use it to trade, to save, to send money across borders, all without touching volatile crypto. Sounds great, genuinely useful idea. Now, there are three ways people try to build them: fiat-backed, crypto-backed, and algorithmic. And these three categories matter more than almost anything else in this conversation, because each one has its own completely specific way of failing. Right now, there are over 200 stablecoins in circulation. The total market cap crossed $312 billion by late 2025. That is an enormous amount of money sitting on top of foundations that, for most of these coins, were never built to last. So the first type is fiat-backed. This sounds like the simplest, most boring, most trustworthy version. You put a real dollar into a bank, you get a digital coin that represents that dollar. The coin is worth $1. You want your dollar back, you redeem the coin. Easy, right? Tether, trading as USDT, is the king of this category. It's the biggest stablecoin in the entire world, with roughly $189 billion in circulation as of mid-2026. For scale, that's bigger than the GDP of most countries on Earth. USDT and its main competitor, USDC from Circle, together control 93% of the entire stablecoin market cap. So when we're talking about fiat-backed coins, we're essentially talking about the pipes that the entire crypto industry runs on. But here's the problem. The whole thing works on trust. You are trusting that when you want your dollar back, it's actually sitting in there. And that trust has been stretched in some pretty uncomfortable ways. Tether, for over a decade, never produced a full independent audit. Let that sink in for a second. $180+ billion in circulation, and no Big Four accounting firm had ever fully verified those reserves. They published quarterly attestation reports from BDO Italia. An attestation is not an audit. An attestation means an accounting firm checked what Tether told them. An audit means someone independently digs through everything and verifies it from scratch. Those are completely different things. S&P Global, the same credit rating agency that grades sovereign debt, actually downgraded Tether's USDT to weak in 2025. Their stated reason was exposure to Bitcoin, exposure to gold, and the opacity of their reserve reporting. That's not some random crypto Twitter critic saying that. That is S&P Global. Now, to be fair, Tether finally hired a Big Four accounting firm for a proper full audit in March 2026. That's actually meaningful progress. But think about the timeline. They spent years running the world's largest stablecoin without one. And there's a second risk embedded in fiat-backed coins that people don't think about enough. These reserves sit in real banks, and when those banks have problems, the stablecoin feels it instantly. March 2023, Silicon Valley Bank collapses. Turns out, USDC had $3.3 billion sitting in SVB. The coin immediately depegged, fell to 87 cents over a single weekend. It recovered, but here's the point. A coin that is literally supposed to be stable lost 13 cents of value in 48 hours because of a completely unrelated banking crisis it had no control over. Even the most well-run fiat-backed stablecoin has bank counterparty risk baked right into its DNA. Now, this is where it gets genuinely dangerous. And honestly, this is the section that should make you angry, because what happened here wasn't some unpredictable black swan. People literally wrote academic papers warning about it before it happened. Algorithmic stablecoins have no dollars in a vault, no gold, no T-bills, no hard assets, just code, and the belief the collective shared belief that the code will hold the price at $1. The moment that belief breaks, there's nothing underneath it. Terra's UST was the biggest algorithmic stablecoin that ever existed. The core mechanism worked like this. UST was supposed to stay at $1 using a burn and mint system with its sister token, Luna. You burn $1 worth of Luna, you get 1 UST. You burn 1 UST, you get $1 worth of Luna. Arbitrageurs keep the price balanced. When UST drifts above $1, people mint it and profit. When it drifts below $1, people burn it and profit. On paper, the system finds its own equilibrium. But to actually get people to hold UST in the first place, the Terra team built something called the Anchor Protocol, basically a savings account for UST that paid 19.5% annual yield. Your regular bank savings account at the time was paying maybe 0.5%. Anchor was offering nearly 40 times that number. People went absolutely wild. By early 2022, Anchor had $14 billion locked in it, and 75% of all UST in existence was sitting in Anchor chasing that yield. One protocol, 75% of the entire supply. That is a single point of failure so obvious it was almost hard to believe. And where was that 19.5% yield actually coming from? That question never had a great answer, because the honest answer was mostly from new money coming in. The moment growth slowed down, the yield was unsustainable. May 7, 2022, someone, or a coordinated group of someones, starts pulling massive amounts of UST out of Anchor, billions in hours. UST slips below $1. Not dramatically, just a little, but enough to trigger what came next. Here's where the system's own design becomes the weapon. When UST drops below $1, the mechanism says, burn UST, get $1 worth of Luna. Arbitrageurs do exactly that. But burning UST means printing more Luna. More Luna in circulation means the Luna price drops. When Luna's price drops, it takes more Luna to equal $1 worth of value. So you have to print even more Luna to redeem UST, which dilutes Luna further, which drops the price more, which means even more Luna needs to be printed. You see it, right? This isn't a bug, this is the design. Under panic conditions, the very mechanism that is supposed to save the peg is what destroys everything. Researchers called it the death spiral. Once it starts, the math works against you faster than any human intervention can respond. Between May 7th and May 13th, 2022, 6 days, UST went from an $18 billion market cap to essentially zero. Luna, which was trading at $87 at the start of that week, fell to less than $0.0001. And the total damage? $60 billion in value wiped out. Hundreds of thousands of real people, not traders, not whales, regular people who were sold the idea that 19.5% yield was safe because the coin was stable. And the thing that should actually make you furious, a 2021 academic paper literally titled Built to Fail described this exact death spiral mechanism for algorithmic stablecoins, word for word. 1 year before the collapse, the structural flaw was documented, published, peer-reviewed, and the project kept growing anyway. Some people looked at the algorithmic disaster and said, fine, what if we use crypto as collateral, but we over-collateralize it so heavily that even a big crash can't wipe us out? DAI, built by MakerDAO, works exactly like this. You lock $150 worth of Ethereum into a smart contract. You get $100 worth of DAI in return. That extra $50 cushion is supposed to absorb market drops before the collateral becomes insufficient. And honestly, DAI has held up better than most. But look at what happens in a real crisis. Ethereum crashes 40% in a day, which it has, more than once. That buffer shrinks fast. The system has to automatically liquidate positions to stay solvent, and if it can't find buyers quickly enough, if liquidity drives up at exactly the worst moment, the cushion disappears before the liquidation completes. In March 2026, we saw a live example of this. Resolve USR, an over-collateralized stablecoin backed by Ethereum, crashed 67% in a single 24-hour period, dropped from $1 to 33 cents. That is the safer version of the model. Still broke, still cost people real money. So now you've got the full picture. fiat-backed coins with bank risk and audit opacity, algorithmic coins with built-in death spirals that activate precisely when panic hits, and crypto-backed coins with liquidation risk during the exact moments when markets are most chaotic. Every category has a structural weakness that waits for the worst possible time to surface. Here's something that doesn't get talked about enough. Two stablecoins, Tether and USDC, control 93% of the entire market. The other 200-plus stablecoins are fighting over 7%. Most of those smaller coins will never reach meaningful scale. They'll never have the liquidity, the integrations, or the regulatory standing to compete. And now there's a new pressure that is going to accelerate that shakeout faster than anyone expected. The U.S. Genius Act became law on July 18, 2025. First major federal crypto legislation in American history. What does it actually require? One-to-one reserve backing. Every coin must be covered by a real dollar or equivalent liquid asset. Full audits for large issuers. Strict federal licensing. And critically, no unlicensed stablecoin issuer is allowed to operate in the U.S. market at all. For Circle, with USDC, who already runs a regulated, transparent operation, this is manageable, maybe even an advantage. For the other 200-plus stablecoins that have been operating without proper compliance infrastructure, the math doesn't work. They cannot afford the legal costs. They don't have the reserves. They will cease to exist in the U.S. market. And in Europe, MiCA regulation, which took full effect in 2025, required stablecoin issuers to hold 60% of reserves in EU-regulated banks and obtain proper licenses. Tether, the single biggest stablecoin on Earth, is being delisted from major European exchanges including Binance and Kraken because it cannot meet those requirements. The largest player in the entire category cannot operate cleanly in the world's second biggest economy. That tells you everything about how far behind regulation this industry built itself. Let's just look at the numbers directly. No spin. $312 billion in total stablecoin market cap outstanding. $33 trillion in stablecoin transactions processed in a single year. At least 25 notable stablecoin failures or long-running depegs throughout crypto's history. That's not random accidents. That's a repeating pattern. 93% of the market controlled by just two issuers, and $60 billion wiped from one algorithmic stablecoin alone in 5 days? Right now, today, there are people putting their savings into stablecoins issued by projects with no audits, no regulatory standing, no real reserve backing, and no mechanism that would survive a genuine market panic. Not because they're reckless, because the marketing says stable, because the yield looks good, because someone they trusted told them it was fine. The history says otherwise. Every single time the market has hit real stress, stablecoins that looked fine beforehand have broken. Not the ones built like actual financial products, but the vast majority that were built like experiments and marketed like certainties. Okay, it's not all bad. Some of these survive, and it matters to understand exactly why. USDC has survived because Circle actually runs a regulated, transparent, audited operation. When SBB collapsed and USDC briefly lost its peg, they resolved it within days because the underlying structure was real. The reserves existed. The legal entity was accountable. The mechanism for getting dollars back actually worked under pressure. DAI has survived because it is genuinely over-collateralized and governed by an active, engaged community. It's messy, it's complicated, it requires constant governance decisions, but it's backed by real assets that are publicly verifiable on-chain. The Genius Act, even though it's going to be painful for the industry short-term, is actually doing something structurally useful. If you have to prove one-to-one reserves, maintain audits, and get licensed to operate in the U.S. market, most of the junk gets filtered out, not because someone decided to ban it, but because it can't meet the basic requirements that any financial product should have met from the beginning. The stablecoins that survive this shakeout will be the ones that were built like financial products from day one, not the ones built like experiments, hoping nobody would look too closely at what was holding the price up. If you're holding a stablecoin right now, and maybe you have perfectly good reasons to, Here's the actual checklist that matters. Is it audited, not just attested? Are the reserves transparent and boring? T-bills are good. Bitcoin and gold as reserve assets are a red flag. Is it regulated in a major jurisdiction? And has it held its peg through a real market panic? Not just normal trading days, but an actual crisis. That's it. Not fancy. But that's the difference between the ones that might hold and the ones that are waiting for their own May 2022. Here's what actually gets me about all of this. The word stablecoin is doing an enormous amount of work. It's promising stability, guaranteed stability, in one of the most volatile asset classes ever created by human beings. And that promise is real for a very small number of them. For the rest, the promise is the product. The word stable is the entire marketing strategy. The actual mechanism underneath is fragile by design. We're at a real inflection point right now. Regulation is finally forcing the question that should have been asked from the beginning. What is actually backing this thing? The Genius Act in the US, MiCA in Europe, these aren't perfect frameworks, but they're doing something important. They're separating the coins that were built on real foundations from the coins that were built on belief. The winners from this shakeout are probably already obvious. The losers are the ones that have been getting away with it because nobody forced them to show their work. $60 billion worth of people in 2022 trusted a promise that had nothing real underneath it. Stable is a promise. The only question that has ever mattered, the only question you should ever be asking before you hold any stablecoin is whether that promise is actually kept.